All right, everybody. Hope everybody's doing well this evening. I want to thank you guys for joining us for our next city tour of the Note Nation Top 40 as we roll into San Diego, or as I like to say that, but San Diego tonight to discuss what's going on in the market out there, what can you expect in the immediate future, and what's going to happen post-COVID. But once again, everybody, thanks for being a part of the Note Nation Top 40 tour. We're over a third of the way through our 40-city tour. Excited about that. San Diego is one of my favorite cities. Oftentimes considered my second home for quite some time between here and Austin, Texas. But anyway, guys, if you're joining us for the first time, thank you for being a part of it. We have a variety of local and national investors joining us tonight, along with we'll be discussing statistics and some of the current numbers that are out there. I tell you, whenever from doing a bunch of these already, it's always interesting what you will find on specific cities and what's going on currently in the market and what to expect in the near future. We'll talk about the second half outlook of 2020. We'll talk about the future opportunities for investors, whether it's real estate, residential, commercial, what's the opportunities and what lies in San Diego and around them. We'll talk about where to look for those deals and how to get started. But once again, guys, our mission at WeCloseNotes.com is to help investors to accomplish their dreams, increase their wealth through debt investing. It's one of our big mission statements we've had for years. Many people didn't know that, but we've had that hanging on the wall in our office for quite some time. But if you don't know who I am, I'm Scott Carson. I've been an active real estate investor since 2002, over 16, 17 years in the mortgage and finance industry. I've purchased over $500 million in debt and mortgages on residential commercial in San Diego and across the rest of the country. I'm the CEO of WeCloseNotes.com. It's our main website if you want to check out everything. I've been teaching real estate investors how to capitalize on distressed debt, distressed markets, distressed real estate since 2004. I'm also the host of the widely popular The Note Closer Show, which is nationally syndicated with millions of listeners each month, along with investing all across the country. I call Austin, Texas home. But San Diego has always been a favorite of mine since 2004, since my first trip out there, golly, going back 16 years. And I have to tell you, there's a lot of interesting things going on, but people have been asking me, why am I doing this? Why am I taking time out of my busy schedule to do 40 different cities and focus on things? Because I think it's an opportunity to help people. I love helping investors like you and me identify opportunities out there. And I know that I get a little bit different insight. They can often help people find a lot of amazing deals. And I love to help people to solve problems. I love being a problem solver. It's one of the big things that I really enjoy doing is helping people overcome issues. And I believe that what's going on right now in the next 12, 24 months is going to be an amazing opportunity for those that decide to take action and realize that, hey, there is an opportunity. There's a big opportunity 12 years ago, through 2015. It's going to be an even bigger opportunity with what's going on right now. And I'm also a big fan of this because I was once a distressed borrower. I was in trouble back in the day. This goes back to 2002, 2003, when the market changed here in Austin, Texas. And I empathize with those that are struggling right now. And I like to find ways and opportunities to help them, but also create win-win scenarios. And I'll tell you something, there's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that was impossible, whether it's an investor or whether it's somebody who's struggling right now, business owner, property owner, borrower, tenant. There's a lot of opportunities and a lot of great ways that you can help people out there and make money doing it at the same time. So I do have a big goal, and I would love for you guys to be a part of that goal in helping to create 1,000 investors over the next 12 months to really tap into this tsunami that we have coming up here in the next 12 months. So where are the opportunities? Let's talk about where the opportunities are. They're everywhere. I mean, I don't care where you're looking at, there's opportunities in every market and every asset class, whether you're in self-storage or apartments or single family homes or mobile home parks or office space or hotels. There is a lot of opportunity. And the beautiful thing, the banks don't care what your experience is. They don't care the color of your skin, whether you're a business owner, whether you're struggling, whether you're behind your mortgage right now. There's opportunities right here, never like we've seen before. Okay, like we've never seen before, everybody. Don't care what your race is. Don't care how old you are. Don't care what your sex is. If you can close on deals and raise capital, the banks are ready to play ball here. They're getting ready here more and more as each day goes on. But anyway, let's talk about what some of the national numbers say for everybody. And I encourage you, if you're watching this live on Zoom with me or on YouTube or on Facebook, feel free to ask questions. I encourage you to ask questions I promise to get you out of here in just under an hour as well too for you, but ask the questions and I'll always be glad to respond as best I can for you. Currently right now, as of June numbers, we're at 11.1% unemployment rate. Basically 1 out of 9 people across the country are filing unemployment right now. That's scary. 40 million people out there are collecting unemployment. Now, out of those numbers, half, 52% of small businesses are expected to fail. That's causing a lot of this unemployment. People have been laid off. Small businesses aren't opening up. Some are in other states and they're getting shut back down. Here in Texas, we've seen that. The sad thing is that before this all happened in March, 1 out of 10 homeowners was already struggling to stay current. 10% of the country was already right at 30 days behind. Most people don't know that. They all, oh, we're only at a 2.5, 2.6% default rate. That's correct. We were in January and February, but that number has skyrocketed, obviously, okay, because we're now 3 times that at 7.76%. That's the national mortgage delinquency rate. That means people are at least 90 days behind. Okay, there are 4 million plus Americans currently in default, roughly 4.1, 4.2 currently at that 90-day period, but there's another 4 million in the pipeline coming down the road. Okay, now the thing to keep in mind is if you look back to 2008, from 2008, it was basically a year and a half until we had 1.6 million defaults. Well, we're already hit that number 2.5 times in really less than 6 months. So if you think it's going to get better before it gets worse, I'm sorry, it's not going to get better. It is going to get a whole lot worse. Okay? Be careful what you're seeing because not everything is being reported out there, especially when you start looking and doing a deeper dive on some things. Obviously, we know mortgage loan delinquencies are recorded our highest spike in 2 years, and it was all across the board depending on what type of loan type you had. Now, the non-prime, as they like to call it, that's the subprime loan, so a 21% increase, okay, in defaults. Expanded prime loans, so the second highest at 12.2, basically 1 out of 8. Reperforming loans saw 1 out of every 13 or 6% increase, and then whole prime loan delinquencies saw a 5.5% decrease. Now, that's scary. Last time they blamed it on the subprime mortgages. Oh, yeah, it's a subprime. Well, we know it's COVID related this time, right? Hopefully the market stays strong, but I'll tell you right now, everybody, home lenders are bracing to see 15 million mortgage defaults. They're bracing for that number. Now, it may get a little bit better. It may get worse. It's still early to tell as the can's getting kicked out down that thing. But here's the thing about you guys in San Diego. You're in the top market for being over leveraged on your mortgage debt. Out of 2,500 cities, San Diego ranked in the top 11% for being over leveraged mortgage debt. That means basically because it's so expensive to live there and your average income is roughly about 55 grand a year. Here's the biggest thing. The difference between median house price and income is driving the high leverage. People are basically way overpaying for houses because they want to live there. We know that. It's a great city. Who doesn't want to live there? But honestly, if you were looking to sell, like I think we got some people on the call, I'd be looking to sell now and cash out before the market comes in and starts hurting. Now let's look at the unemployment rate and roll into something different here. Feeding this default rate, obviously, is people aren't going to work. They're struggling, okay? Now this is the June number. For the state of California, dropped from 16.4, which it held the same. You can see 3.9 January, 3.9 in February. Bumped up a little bit in March, up to 16.4, stayed the same for May, and in June it came down 1.5 points to 14.9. Not bad, right? Well, let's look at the rest. Let's look how San Diego compares to that. So 15.9 is California. San Diego is right at 15%. San Diego County is at 15%. San Diego City is 14.7. But the greater San Diego area with Carlsbad, Oceanside, and things like that, all comes in roughly right about 15%. Okay, California is at 15.9, so that's a great thing that San Diego's a little bit better, but it's still a rough time to be out there. You're still above the national average right now. Oh yeah, this has just changed. I gotta go back and change the number. 13% unemployment rate across the country. Ouch. Okay. Now, if you look at the markets or the zip codes in San Diego, start looking at some of the current foreclosures. This is kind of skewed because this looks at current numbers, not looking, especially with defaults and forbearance agreements kind of delayed. Here's the foreclosure numbers. The #1 zip code in the greater San Diego area was at 92121, had one in every 1,900 homes, basically. San Diego's itself is basically one in every 10,000 homes is in foreclosure. It's a smaller rate in a lot of places, but you have, what I want you to see is you have a big discrepancy between the dark blues, the highs, down to the lows. Okay, so you've got some people really struggling in San Diego County to stay in their house. Now, if you look at also, this shows the foreclosure stats for San Diego. Basically, month over month, there's no, 0% because the fact nothing was gold. 112% over the previous months. Yeah, we had a few auctions that went through, not on owner-occupied houses, more on the investor-style loans, and the bank loans were up quite a bit as well compared to last month. But 300%, if there's 3 compared to 1, that's a 300% return. So it's skewed there a little bit. But if you look here at the number of foreclosure filings by auctions, bank-owned, obviously down. You can see this number dropped off the charts in March, and it stayed very flat as far as pre-foreclosures. Obviously, it's kicking the can down the road. Auctions are ticking up a little bit. Bank-owns are about the same, still very low. And you can see a lot of the cities out there have stayed flat or dropped down. But here in June, San Diego saw a little bit of an increase on the foreclosure activity. Okay. Now, looking at the market, it's right on track compared to the rest of the national average, 0.01%, they say, as foreclosures. So keep that in mind. Hey, San Diego's still a very strong market overall, but there are some areas that are hurting. Okay. There are definitely some areas that are hurting out there for everybody. Now, Black Knight, which is obviously a big company, they talked about that from May to June, we saw a 20% increase in delinquencies month over month. That's no surprise. And 123,000 homeowners became past due on a mortgage, 4.3 million. Okay. Now we expect this number to increase by more than 50% it has increased by more than 50%. It went from 2 million to 4.3. We expect to see that number to increase up to 4.8 roughly. And that's the scary thing. 7.76 right now, month over month, 20% increase, obviously way over what it was last year. Okay. Here's what I want you guys to take a look at. Number of properties are 30 more a day past due, but not in foreclosure, 4.123. Month over month change, 23 year over year change. You're going to see more stuff coming down the pipeline, everybody, very shortly. Now, it may be just the cans kicked down the road by the government agencies, but here's one thing that concerns me, especially about California. Top 5 states by 6 months deterioration. Basically, looking at numbers over the last 6 months, you've got the California, yay, way to forgo for California, has one of the biggest, the highest deterioration rates in the state. And it's actually San Diego, if you look at San Francisco and LA, you guys rank actually worse than those 2 cities, okay? This is a non-current totals combined foreclosures and delinquencies, a percent of active loans in that state. Yeah, basically the number's getting worse. The number's getting worse, okay? And if you look here at this map, this is a great map I got from a buddy of mine. This kind of outlines what states are doing some stuff. Now, the dark green, where it's all solid green, those are current statewide moratoriums as of last month, or actually as of this month. The lighter green, like which California falls in, means there's current local moratoriums. The really light green, like here in Nebraska, says states where evictions have resumed. Okay, but then down the bottom, no state, all like Texas here, no states or local moratoriums issued. Yeah, here Texas are getting rock and roll, but California, it varies on a local city by city, county by county for the most part. And right now, if you look here, California, basically, you gotta love Governor Gavin Newsom, extended an authorization allowing local governments to stop evictions through September 30th. That was just less than a month ago. That's exactly what San Diego did the next day, extended it. Basically, now it was close. It was a 5-4 vote. Pretty close. It didn't pass all the way. It's pretty close. 5-4 vote saying that basically you can't be evicted, whether you're a residential or commercial investor out there. Now, you're starting to see it uptick a little bit on the investor loans, investor borrowers. There's a 10% increase in foreclosure auctions. We saw a little bit of this. That's the last 8 weeks ending as of July. So that's all of May, all of August. End of August, I'm sorry, not end of May. All of May, first basically week of June, and then basically the first 3 weeks of April. So that number's starting to increase. You're starting to see it start to tick up. People are going to start enforcing stuff on a variety of things. Now, we all know, people have been talking about forecasting economic tsunamis, foreclosures rise, and mortgages sink underwater. All right. People aren't paying their mortgage because of the fact they're not working. We all know that's issues on stuff. It's going to get worse as we get out there. So what kind of loans are we seeing out there, the biggest defaults? Well, really, honestly, it's not all subprime loans. You have a lot of the FHA loans are really leading the percentages when you look at a lot of government stuff. Not almost 10% default rate. Expect that's through May. We expect June numbers to be higher. Basically 1 in 10 FHA borrowers. The reason for the FHA is if they've been financed recently, they didn't put any money down. There's 3.5 down payment required, but that was paid often by the lenders, and then closing costs were often paid by the lender as well. Conventional loans have a much lower default rate, 3.16. VA loans, 4.65, and then all other loans at 4.36. You still see an uptick, okay? That's why you're seeing a 7.76. It's a triple default rate than what it was 120 days ago. Now, the beautiful thing is a lot of people have gone on forbearance. You have that number kind of slowing down a little bit as people are going back to work, which is great. We're still sitting at roughly 4.6 through June of this year. So that's the thing. They're tweaking down a little bit, but they're kicking back up now. The thing about forbearance agreements is Freddie and Fannie, with their loans, they've already told people it takes 6 months. And inside, if you don't know this, some of the inside sources I have said, oh, we're willing to give them another 6 months. So a full year of forbearance agreements. And then at the end of the year, we're still even willing to negotiate with them at that. So the banks have some leeway that finance this stuff. All right. Fannie and Freddie, I don't know if the FHA is going to do it, but they're like, oh, we'll wait. And the bank's like, okay, great. Okay, we can evaluate our portfolio. Okay, now is that good news or bad news? It's good news for the people that can't pay. It's bad news for the banks. It's bad news for the investors like you and me out there. Okay, now California has a slightly lower default rate than the national average, but you've got some longer FHA foreclosure timeframes to foreclose. On an FHA foreclose, it's still 480 days. That's still over a year to have to try to foreclose on a non-judicial. Obviously, the backlog of forbearance agreements. So you're not going to see a wave of REOs or foreclosed home hit San Diego or California for at least 12 to 18 months, if not longer. Okay, so if you're waiting around to buy something cheap there, you're going to be waiting around a while. Okay, not a good thing. A lot of those deals are going to end up not hitting the market, or the banks are going to sell that debt off to investors and let them deal with it. Okay, so let's talk about some of the commercial debt. That's all residential we've talked about. Let's dive into the commercial space here. We see, boarded up buildings. We see for rent signs, out of business. It's going to get a whole lot worse, not just for some of the bigger companies out there that have closed their doors and filed bankruptcy. I mean, we're seeing record filings in the business side for bankruptcies. It's getting worse for small investors like you and me, small business owners. We know that commercial real estate has been a long boom. It's been overpriced for a while. We knew the market needed to correct itself, and we're seeing that right now. Now, looking at the different types of asset classes in commercial space, you can kind of see, obviously, your lodging, your hotels have been the hardest hit, roughly 27%. Retail, this number is actually a little low. It's actually closer to 20% than the under 15. Office is low. Apartments, student housing is starting to tick up there quite a bit. Seniors is the lowest class. Single family residential, we know that, where it's kind of still low compared to some of the commercial rates. Okay, so the thing you got to keep in mind, looking at some of these numbers, basically 1 out of 4 hotel loans are in default. In other parts of the country, 1 out of 4 retail loans are in default as well. Retail's, we've known, has been on life support for a while. Malls, they expect 1 out of 2 malls to fail and just not really reopen back up, because those businesses, people don't want to go where they congregate inside the death of the loans. I mean, here's the thing. Simon Properties, which is one of the biggest financiers of malls and management companies, is taking it really badly, okay? Office vacancy is set to increase to roughly about 20% nationwide. A lot of office space in San Diego. And there are some articles talking about how a couple real estate companies, they're expecting over 30,000 square foot in subleases to come on the market here in the next 30 days as well, too. You can expect at least a 15 to 20% vacancy rate for retail and restaurant space. And in areas like the gas lamp districts and the other areas, you're going to see a higher increase in that as people they're just not coming down. They're not traveling anymore, okay? You're going to see rents on commercials drop another 10% by year end, and then probably another 5 to 10% across the board in next year. Now, We know the delinquency rates are tripling. It's getting really bad out there on the commercial side. You know, it's sad. 1.3 trillion of property loans is expected to really be gone. I mean, the commercial mortgage-backed security market lost $50 billion in value in March. And there's 11 billion in looming commercial mortgage-backed security hotel loans at risk right now, including San Diego's, Del Coronado. That's a huge loan that was supposed to be refinanced out in the next 6 months. Probably not going to happen. San Diego is the number 2 largest market with hotels that are being hit as well out there. Not just Coronado, Del Coronado, but a lot of others. Yeah, I know. It's one of my favorite places, Jeff. It's Hotel Del No. Yeah, exactly. Best sangria, one of the fun places that we love going to in San Diego, staying there and being part of that. I'll give you a little bit of idea in the article. San Diego is the second largest exposure with $674 million in loans coming due in the next 6 months, collateralized by 29 hotel properties, okay? Big one, obviously, out of that is the Del Coronado. There are some extensions involved with that. But the thing is that San Diego was close to a zero probability of refinance default under the base case, but that's expected to jump to 22, 25% under what's going on right now. Scary. LA's number 1 in hotel defaults, they're expecting. Orlando is number 3. Hey, Ratland, right there. East Coast, West Coast, everybody. Disney is a big attraction for LA and Orlando. So also, I mean, here's the thing. Is it all the big guys out there financing stuff? No, it's not all the big guys, the big funds that are financing stuff. Now, go back to 2007. Yeah, it was them. 64% of the distressed commercial real estate loans were backed by the CMBS market. But over the last couple of years, the banks have got heavily involved. If you look at the risky lending they've done right now, 53% of the distressed loans are on the bank's books, not CMBS, but actually FDIC chartered banks, okay? Just the tip of the iceberg. Now, what's happened is this bank's gotten greedy. They want to get up to the trough as well. So they're financing at 65 to 70% of the as-is value based off the cash flow. Now, if rents go down and vacancy increases, your property value drops because the cap rates drop. Your net operating income drops dramatically. Well, the banks are only going to be in the hook for up to 70% LTV. When that values drop, they're going to go back to the borrowers and say, hey, I need you to bring 5, 10, 20% cash to write down this loan because you're no longer at 70 or 65, you're at 85. All right. And then we saw a lot of this happen. We saw this happen with Capital One years ago. Some of their small commercials, their values dropped. They were willing to sell distressed debt off at 50 cents on the dollar of as is value, not or of the unpaid balance or the value, depending on which is smaller. Okay. It's a lot of opportunity for investors for us to step in. Now, you can do a variety of things. The best thing that I would recommend is, hey, if you got some money, step in and start providing capital to buy out some bad loans from these banks, or work with the current borrowers to try to reposition the phone. Probably, give them the keys to walk if they're not going to be back in, so you can look to trying to find people to move in. If not, it's going to be difficult because you're going to look at in a year right now to look at basically if there's going to be 80, 85% vacancy and your rent's going to be decreased by 15 to 20%. You have to look at what rent is now and expect it to be 80 cents on the dollar of what it was. That's what your starting point roughly should be, if not less, to try to attract other people to move in. And the big offices, there's a lot of companies in San Diego that are downsizing over the next 6, 12, and 24 months, okay? If you pay attention to any of the news out there, Carl Icahn, billionaire investor out there, has been short the commercial market for the last 6 months. He's expecting this thing to blow up. Going to be a whole lot worse than 2008, worse than the housing market in 2008, okay? And he says nobody's really looking at the commercial space. Everybody's looking at the residential space. They're not paying attention because the commercial markets aren't being saved. They're not being the ones, oh, hey, we'll give you a 6-month forbearance agreement. No. He goes shopping malls, office buildings, hotels, and retail. It's all credible institutions that did it again. And it's opportunity for you if you can come in and buy something because the bank's willing to sell it. And hotels, New York, so there's some New York hotels going at 22 cents on the dollar. Downtown New York City, $260 million loan that the bank is willing to take less than 20 cents on the dollar. 1,700 room hotel. Makes you wonder how cheap stuff is going to get in San Diego here before too long. Okay. Lots of opportunity out there. We all know commercials delinquencies are stretching higher, getting crazy. The banks stand to lose $48 billion in commercial real estate loans here in the next couple of years. Now, the thing that you got to keep in mind too, just recently, just the other day, news came out that banks are putting away cash, they're putting away reserves to save for the bad sell-offs that they're going to take into shorts, including Bank of America. On Friday, July 16th, which is just a few days ago from the time it's recorded, they expect to see a big chunk of the pie, okay? Out of that $48 to $50 billion, Bank of America's losses are going to probably be around $5.1 billion. That's their piece of the pie, 1/10 of the pie. Of course, Wells Fargo, Citibank, Chase also have some difficulties going on there, but Bank of America is going to be the biggest person that's going to have some difficulties on the commercial side, okay? So where are the opportunities in what we're seeing here today? Well, you can buy foreclosures and REOs. Yeah, we'll see you in 2 years. By the time stuff gets bought and foreclosed out, it's going to be 12 to 18 months. And you're going to be fighting every other Yahoo out there who wants to be a foreclosure expert, okay? You're going to buy REOs. It's just not going to be the same thing like we saw last time because of the fact the government stepped in and kicked things down the road for a little bit. Fix and flips, I'm sorry, that's going away. Unless you're going to be using your own capital and you're finding some smaller pocket deals, hard money lenders, mezzanine lenders have kind of dried up a little bit. They still have a lot of money, but they're kind of waiting on the sidelines. You're not going to get to 100% financing if the market drops. Rentals, I wouldn't want to be in the landlord space right now either because of the fact of if people are delayed in some places, San Diego's, and you get till September, what happens then? Who knows? We'll be delayed another 60 days, another 90 days, or we'll be delayed a year like in other parts of the country. Who knows? The real opportunities for investors these days, though, lie in the debt game. That's where the opportunities are because the banks will be looking to move stuff off before the forbearance agreements end. And if you look at the numbers, most banks are moving assets in the fourth quarter. Now, the fact that they've had, by the time October, November, December rolls around, they'd have had 6 months to review their portfolio, see who's in default, see who's high, ask for a forbearance agreement. And I guarantee you they're going to start looking to move that stuff off at a discount before it gets really bad because they don't want to carry this stuff in the next year. They would rather look to move it. Now, the residential, the bigger banks, you're not going to buy a one-off note from Bank of America or Chase. They're going to be selling those in bigger pools to Wall Street and other places. But there's a lot of non-government-backed lenders out there that have stuff on their books that's being affected by this, okay? Those are the guys, those are the institutions that are going to look to move some stuff here soon. We're also already seeing commercial notes this quarter. A couple conversations, people are telling me that they're seeing more commercial deals than they've ever seen before. And it's mind-boggling to them, they say. And what do you have to do? You got to be creative. You know, like this hotel developer up in Illinois, instead of keeping it as a hotel, brand new open hotel, he turned it into an apartment complex and sold it off. Beautiful interior, great 2 bedrooms. We've got a student of ours, a buddy of ours, Garrison Gilbert, is doing this in Pennsylvania. He's out of Maryland. But he's looking at smaller hotels that he can convert to apartment complexes because that's a play. There are plenty of non-chain, non-flagged hotels out there. We know the smaller hotels that you can pick up. Raise a little capital and turn into an apartment complex if you need to because there's plenty of needs for apartments. Or you could be like this guy in downtown Seattle, took a 170-unit office building and converted it to self-storage. He's like, yeah, nobody renting my offices now. We'll turn around and rent them out as a self-storage for a while. It's a brilliant play. I mean, literally a brilliant play that I'm actually looking into this deal to take it down as a deal that we're looking at, okay? Now, where are the opportunities lie for you guys? Because that sounds great. Everybody's like, oh, great, awesome, but I don't have $5 million, I'm $2 million bucks. Here's the biggest opportunity that my guys on Wall Street are telling me. The biggest opportunity is going to be those assets at $2.5 million or less. Okay. Anything over 5 million, you're probably never going to see. Okay. But you have a lot of guys, a lot of banks, especially finance that sub $5 million mark initially because that's how they like the loan aspect of it. So there's a lot of this loans, a lot of great properties that are under that $2.5 million loan mark in value as well that you can pick up at a pretty sweet price. And then if it's occupied, turn around and be flexible with the tenants or the borrowers in some sort of fashion. It's the biggest overlooked asset class right now, that small 5 million or less, especially 2.5 million or less. And the banks have a lot of this stuff on their books, literally a lot of this stuff on their books that they're looking to get rid of here in the next 60, 90, 120 days as the year rolls around. So let's talk about some of the banks in trouble in California. We know there's thousands of banks that are lending in, there in California. I like to track things on a quarterly basis I use a report called the Bauer Financial List. And I have the most recent list for banks. Literally, I pull a whole list across the country of banks that have at least 5 branches or more. Okay. And it turns out to be over about 2,000 banks. Now, there are 45 of those banks that have their home offices in California. Yes, there's thousands of banks that lend in California, but 45 of the FDIC chartered banks that lend in California alone. So it's just a small sprinkling of what we're talking about here. Okay. Out of those 45 banks, there's $2.3 billion in 90-day plus accrual loans in default. Basically $51 million average across the board. Okay. Average is about 3% of each bank's are 90 days past dues. That number is going to double in the next 60 to 90 days to 6% or worse. Remember, we got this whole other wave that's not in 90-day default yet. And it's equally about that same amount. Okay. 1.4 billion. So roughly 75% of that is in single family homes in California off of those. The biggest 2 guilty parties are MUFG Union Bank and then Citibank. MFU basically has over $100 million in defaults. Okay, CIT Bank has $263 million in 90 plus day defaults. Okay, that's a lot of paper out there. Okay, a lot of papers. And that's, you guys, I'm sorry, that's just the residential side. That's not taking consideration what they have on the commercial side. So why would you want to buy distressed debt? Why would you want to buy a non-performing asset? I get that a lot of times. One, because you can start seeing deals now and you see it way 6, 12, 24 months ahead of what everything is. There's not an MLS for notes. But the beautiful thing is the banks are willing to sell this stuff at a substantial discount for you to take on their issues. Okay. And they're willing to pay you for it, basically in the value of a bigger discount. Okay, so that's a beautiful thing. You can buy the debt at significant discounts depending on the location, the foreclosure time frame, values, condition. However default the asset is, the asset class is going to be a bigger discount. Okay, you can purchase the debt and turn around and control the asset by buying this stuff at 30 to 70 cents on the dollar off. Already seeing stuff at 70% off. All right, in some of these asset classes. Craziness. Yes, if you're buying this, you become the bank, you may have to wait a little while, 6 months. You may need to work with the borrowers in some sort of fashion. But the idea here is the strategy include to go, not to go foreclose, but to try to get a reinstatement, a modification, a short sale. If you got to foreclose, okay, or flip the loan to somebody else if you understand what's going on, or offer up deed in lieu cash or keys. The nice thing about commercial debt is that you have the right to collect rents. So if the borrower is renting the property out and they're not paying you, they're using it as an ATM, you have the right to go and collect the rents yourselves. There's a beautiful aspect of that commercial loans. Take over the note and turn it into a reperforming or cash flowing note. Or if you want to, take over the property and do what you want. Sell it, keep it, rent it, whatever, owner finance it to somebody else. There's a lot of opportunities and advantages of distressed debt, and it can be great returns. If you're picking up a loan, let's just say 50 cents on the dollar, okay? At 5%, and the borrower, okay, can start paying on time now because you're going to forgive 6 months of the back payments. That's not like a 10% cap rate. You get them to start bringing a little bit to the table, get caught back up, your ROI goes up pretty fast, pretty quick, everybody, okay? Now, there's other advantages of note investing. One is for those of you that are struggling that don't have a big budget for marketing, we don't do direct mail. We're not sending out postcards, yellow letters, bandit signs. We don't do that kind of stuff in the note space. You're dealing directly with the banks, asset managers. And so if you've got email, LinkedIn profile, and can pick up the phone and follow script, you can make money at this business. You can do some amazing and really great things to make a lot of money in this business. And the thing here's too, one bank contact isn't just one deal and that's done, one and done. No, they often will have lists that you can look at on a quarterly basis. 1 second. Like I said, if you're reaching out to banks, I've gotten lists from banks that I've had for 6 years where I made a contact, in 2014. I get a list, I get a quarterly update from them when they have stuff, when they don't have stuff. it's such a beautiful thing that I don't have to go out and drop 5 grand, 10 grand, 20 grand in direct mail to get 1 or 4% of the people I mail out to even respond back to me with the hopes of getting one deal from those people. It's a much smarter way of marketing, I believe, going direct to source. And the closer you are to the source, the bigger the discount you get because, hey, the sweeter the deals too, because you're right there. There's not a lot of room for bad things to happen to get kicked down the road a little bit. The closer you are to the source, the better the deal flow is, everybody. And if you want to, hey, I get lists all the time that I can cherry pick from, either keep for my own portfolio, or I can, flip it to somebody else if I need to. If you can put some money together and buy in bulk, great. The banks love it. They'll get even better pricing to you for buying in bulk. What we're hearing is the same thing I heard in 2008, 9, and 10. When they send you a list, you're like, oh, crap. It's not, oh, crap. It's like, what can you buy? Buy something, please. Please help us out by taking this off our books, okay? And if you're looking for residential or commercial assets, it's a great thing to do. It's basically doing the same type of marketing, the same set of skills to find these types of deals to make money, okay? And I cut my teeth in commercial deals back in 2008, 9, and 10, 11. Always been buying, looking at commercial deals. Love residential too, but it's going to be a little while till you see some of the better residential deals. You might as well dive into the market and start building your systems and building your contacts to really make some great things happen. And look, if you don't have money, you're struggling, I get it. If you're not paying your own mortgage because you're in a forbearance agreement too, I get that. The banks don't give a rat's ass. There's plenty of investors out there to fund your purchases. Use OPM. I mean, if Warren Buffett is using OPM, other people's money to fund deals, you can do it too. Guys, gals, there were 15 million homeowners underwater in 2010. We're going to see that in the residential side. We're going to see close to that in the numerical side when it comes to the commercial side. Maybe not 15 million, but a substantial amount of commercial deals out there are already in default, have been in default, and are just waiting for somebody to step in, like you and me, and make this a win-win. And for those that are like, well, are there investors out there? I don't know. You're in San Diego, okay? You are in San Diego, California, one of the richest markets in the country. How do I know? Because I do my research. There's over $9 trillion in retirement funds out there between IRAs and 401ks across the country, over $9 trillion plus dollars, okay? A lot of it's not making anything, sitting at 0%, 1%, 0.5%. In San Diego alone, there are 27,000 investors with an IRA, okay? 27,000 investors in the San Diego County. How do I know? Because I know. Out of that, 2/3 of them have at least 18,000 have at least 150 grand or more in their accounts. How many people do you need to talk to raise $1 million in San Diego? 6, 7 people, maybe more. I think it's a little bit higher, but yes, 18,000 out of the 27 have at least 150 grand or more in their accounts. We do our research. Now, great thing. So what? Okay, I'll go raise capital. Great, I'll go raise capital. I'll go find it. I'll go market these people, and we teach people how to do that. But maybe you don't want to do that. Well, maybe just flip the damn deals that you find from the banks to other investors, because San Diego has plenty of them. There's over 21,000 real estate investors, people that call themselves real estate investors in San Diego. That's not including all the, hey, I do something else, and real estate is my side hustle. 21,000 real estate investors, not brokers, not agents, investors in San Diego County as well. So flip the deals to somebody locally or flip them nationwide. Those are just the numbers in your neck of the woods, everybody. So there's opportunity everywhere out there. And people always ask, do you want to be the bank or the borrower? Well, everybody's in the note business. You're just on the wrong side of the payment stream. You're paying out your mortgage, or trying to, paying out your car payment, paying out your credit card, your medical credit card, whatever it might be, student loan debt, your bubba down the road, your weed dealer in San Diego, maybe owe him, I don't know, whatever. But you got money going out. You want money coming in. You want to be the bank. And that's the biggest thing I can tell you. The pen is a lot mightier than the hammer these days, everybody. All right? The bank always wins. Okay? And you can become the bank by really stepping in an opportunity once in a lifetime, once in a decade, once in 20 years, than what it used to be. And they're talking that this may be worse than 2008 on the commercial side. This may be going back to the resolution trust corporations and the savings loan scandals as the big wave of commercial debt hitting us. Yes, plenty of residential loans along the way too. But you guys, if you want to take advantage of the opportunities, you got to be able to, hey, dive in the water when there's blood in the water. When everybody's running one way, you're on the opposite direction. Everybody's like, oh my God, oh my God. I'm like, oh my God, yeah, okay. So how do you tap into the tsunami of deals that we know are starting to hit the market these days? Look, I've been teaching real estate investors about notes since 2010. Okay, that's why they call me the note guy. I've actually been doing this since 2008, but actually teaching classes on this since 2010. I've helped thousands of investors purchase their first non-performing note and go on to buy multiple deals. Okay, buy the first 2, 3, 10, 20, 60, 100, 200 out there. And it doesn't matter if it's residential or commercial. You can buy a lot more residential. You can also buy a lot in commercial too if you know where to look and which asset class if you have specialty in that. And I don't care if you're looking for cash flow or you're looking for something to add to your asset growth. There are opportunities everywhere depending on what your main focus is, okay? If you want to buy one-offs, guess what? There's never been a better time to buy one-off commercial deals. Banks have always sold one-offs on the commercial side, never always done it on the residential side, but they're willing to do that. If you can, hey, reach out to a few more than 9 investors in San Diego. I bet you could raise some capital to buy in bulk as well, okay? And we've seen trades from 25 grand to 5 million plus. Cheapest note I ever paid for was $7 that I flipped for 5 grand. Biggest trade I did was 184 assets. Monetary wise, was over 5 million bucks. There's opportunities out there. I don't care where you're at. A lot of people want to start off using their own funds. I'm a big believer. Hey, you might as well use other people's money because there's literally 18,000 people with 150 grand or more sitting in their IRA not making anything right now. Okay, and the bank doesn't care what your credit is. They don't care if it's your own funds or somebody else. They don't give a rat's ass as long as you can fund. And like I said before, if you know how to send emails, you can jump on LinkedIn and connect with people, or can jump on the phone and dial for dollars. You can make money doing this. This is not a complicated business as some people make it out to be. And I don't care what your focus is. We talked about in the beginning. Single family homes, great. Apartments, great. Hotels, retail office, self-storage, mobile home parks. There's deals in all asset classes out there. Okay? If you can find a deal and get creative on it to make a win-win scenario, win for you, win for the borrowers, and actually a win for the bank too. But it's a win for you, win for all parties. You can really make some great deals happen and come create some even stronger stories to really save America, because that's what America needs right now. It's investors like you and me stepping to the plate and taking advantage of this opportunity to really help some people out of some holes and really create win-wins, okay? Just like the borrower here in Southern Illinois and all across the country, it's a similar deal. We see people, hey, they refinanced their house, they pulled some equity out, boom, the husband got sick. Okay, boom, the market dropped. Now they've been trying to do a loan mod for 4 years when we came across the note. We bought the note, got on the phone, negotiated a loan mod, a trial payment plan, 30 minutes, cut 26 years off of her mortgage. And I made a very nice return. Got all my investment back in the first year, and I had another 6 years of her making payments to me until she paid her off her house. That's a win-win. And I don't care if you like small houses or you like something a little fancier, like beachfront condos in San Diego was one of my first deals. Picking up a $4.5 million loan from the Bank of Arizona on 3 condos, $3 million condos, right on the middle between Mission Beach and Pacific Beach. Really walk out the door, jump the little ledge there, you're on the volleyball courts, okay? Pick that note up on a Bank of Arizona, negotiated a short payoff. Actually, the developer signed the properties over to us. We ended up selling and making $1 million on it. Not a bad deal. And then you also, hey, maybe you don't like something that big. We all know that there's a lot of small apartments in San Diego, like this one in Mansfield is another note we bought. Capital One had financed this one. Borrower owed over 700 grand on a deal, okay? Sorry, 700 grand was the value, 548 was what they owed. We bought it at 375 for an 8-plex. Okay, yeah, the borrower was using it as an ATM, but we were able to pick it up at a cheap price, flipped it for 35 grand in 30 days. 35 grand is not a bad day. It's not a bad month. For some people, heck, for the majority of San Diego, that's 60% of an annual income. Bought it at 375, had flipped it to 450, and actually didn't even use our own funds to do it. I can teach you how to do that, everybody. That's what I've been doing for years, teaching people how to make money in the note business. And I don't care if you do it big or you do it small. There's plenty of opportunity, plenty of crumbs falling through the cracks for all of us to dive in, just like some of my friends out here. Gene, Gene is out of Indiana. When I met him 5 years ago, he was doing a little fix and flips here. He had some real estate experience, but was working as a full-time hot shot driver and kind of scared about doing things. We spent some time with him, taught him some things, trained his mind, showed him the opportunities out there. And I got an email from, it was a text message from Gene about a month ago. And Gene had sent me a message saying that he bought his he was closing on his 135th asset. Okay. 135 deals in 6 years. He had over 13 million invested with him that we taught him how to raise capital. And he's gonna make 7 figures. That's not too bad. He says, Scott, I don't work as a hotshot driver. I only work on cars of the ones that I want to rehab. He's a big car aficionado out there, loves rehabbing, but it's a beautiful thing. He said, I'll never retire. And I found something that's gonna pay better than anything I could ever find. Thank you. And we love success stories like Gene. That's one of the few pictures you'll catch Gene without wearing a ball cap, okay? Very proud of him, out of a small town called Elkhart, Indiana, on the north side of Indiana. Then you got the likes of Laura Blunt. Laura's an absolute dream, just an absolute great person, big heart. And she was like many investors when we met her about 4 years ago. She was going to real estate investment clubs, trying to figure out wholesale and trying to find a deal in a competitive market. She lived in South of Austin, was trying to just make whatever she could. We met her, trained her in the note business. She bought 2 deals in her first 30 days, had bought 14 or 18 notes by the end of her first year and a half. Got some cash flow, got started really good cash flow coming off of that. She's now closed on over 100 deals and is getting ready to close on a trade, one single trade, a $4 million trade on over 138 performing assets at like 53 cents on the dollar. Life-changing. And she just moved from Austin into her dream house in Maryland, house that she always wanted to move into. And so we love stories like that. We do a lot with that for people that are struggling. There's so many investors out there trying to figure out what works best, and they don't have a clue right now because the market's either competitive or just difficult. You know what's going to be paying here for the next 6, 12, 24 months? Notes, everybody. Got to know what you're doing. Our buddy Keith Collins out of Mason, Ohio. Keith has had a lot of real estate experience. Actually, he was a mayor of a small Ohio town, if I remember correctly. Done a lot with the city government, fixed and flipped, done some things. Learned the note business from us a few years back and fell in love with it. Absolutely fell in love with it. Now I think he's going on his 3rd or 4th year in the business. He sent me an email and said, Scott, we're going to make over $1 million in 2019 from the note stuff. $1 million because of what you taught us. And I love those stories. I love helping people change their lives. But these all have a little bit of experience. What if you don't have any experience right now? What if you're sitting out there like, oh shit, Scott, I don't know where to start? That's okay. We can help you do that, just like our buddy Ralph here. Ralph is out of San Diego. A young guy, owned a car detailing company in San Diego, down in Chula Vista. Employed 15 people. But what happens when you're not driving? You don't want to pay to have your car detailed because you can do it yourself because you're stuck at home. So he had to close his business, had to lay off all 15 of his employees. But thank goodness he dabbled in the real estate investing side and starting in November by learning about notes. He doesn't even own a house. Never bought a house before. Immediately in his first 30 days, he bought 2 notes that he got reperforming, making roughly a 20% return with some of his own funds, less than 50 grand. And then he bought 3 more deals with other people's money. He's raised over about 100 to 150, if not 200 grand with other people's money around friends, families he's been talking to. 2 of the deals he's going to flip in 6 months and basically almost double his investment. And the 5th one he's still working through. But he had 0 experience starting off. We taught him, we trained him, and he's off rocking and rolling. How many of you guys need something? How many people out there need some sort of solution and need to start building some skills in case something happens? We all know something has happened to a lot of people. But the beautiful thing that we are so proud of is that we've helped so many people out there do amazing things, close on a ton of deals, and really not only make their lives better, but also making the lives of the borrowers that they're helping out. They're modifying, they're working, because a foreclosure doesn't just affect that house. It affects the neighbors, the block, the neighborhood, the zip code, the city, the county, and the state. We know it affects things. If you can step in and keep somebody from going to foreclosure by buying a note and modifying it, keeping their house, that's actually where we make more money. High returns by keeping people in their houses. And it's one of the things that we've taught and been successful in teaching hundreds of other students across the country to go out and do the same thing for their own portfolio. And we love helping people. How do we do that? Well, we help them out with our training. And one of the easiest ways to get started in learning the note business is to attend one of our one-day note weekend trainings. It's a one-day, we call it the Cliff Notes version of our note training. You're not going to learn the entire note business in one day, let alone 3 days. But it's a great starting point to stick your foot in the water to see if the water's warm. See if you want to dive in. You learn some things, realize it is not as difficult as a lot of people make it out to be. It's actually kind of a simple business. We have a one-day workshop, like I said, called Note Weekend. It's yours truly teaching for the 8 or 9 hours, a few breaks here and there. We live stream it via Zoom like this on a Saturday. The replays are available the next day on Sunday, so you can watch those if you got to step away or rewatch it for it to sink in a little bit. We include a manual along with that, so you can walk along with it, along with several other hours of training videos from our vendors and things like that. It's a little investment of $49. I know we usually charge $99 for the one day. We dropped that, cut that number in half to $49. Like I said, it's just yours teaching from 9 a.m. to 3 a.m. It's not a pitch fest. I literally spend the 9 hours spending the time going through step by step with you on a variety of things. The next one is this upcoming Saturday, July 25th. The next one will be the third Saturday in August. And we've got a lot of things that we cover in our one day. You'll be surprised. You can go to noteweekend.com and see the step, the hour by hour itinerary. You can also get signed up there at noteweekend.com at $49. The minute you get signed up, we'll start sending you some stuff the next day. So you can start learning now. But we'll talk about how and where to find the deals. We talked a little bit about that tonight. We do a bigger deep dive into it. And I guarantee you, at the end of the first hour, you'll be like, oh my gosh, I know where to go now. I know how and where the deals are at, okay? We'll talk to you about the second aspect of that, how to raise capital, how to raise OPM, how to find investors around your county, around where you're located at, okay? We'll talk about the different exit strategies and how to make money, all right? How to actually make money in the note business. What? Yeah, you don't just want to buy something. We'll show you actually how to make money, okay? We'll talk about the different vendors and the teams that you need. There are people there to support you. There are servicers. You're in the debt game. It's different than buying a house. You're buying the debt, so you've got to be compliant with CFPB laws and some other things, but it's not that difficult. We'll show you how to buy deals cheap enough that you can have your investors fund your expenses. We'll also talk about some of the different loan trading platforms that you can start looking at deals right now, whether it's residential or commercial, whatever your flavor is. Start looking at right now. There's no nationwide MLS. There's a lot of smaller little trading platforms, but hey, I often like going direct to the source of the bank. That's what I like to do, okay? And we'll cover a lot more in the one-day training for Note Weekend. And I encourage you, like I said, go to noteweekend.com, get signed up. It's just $49 for that. And if that's not good enough for that, I'll throw in some other bonuses for you. How's that sound, okay? So along with you guys getting it at half price, we'll throw in also a one-day calling banks training. That's right. You'll have me on the phone watching me like this, watching over my shoulder, make phone calls to banks for 4 to 5 hours. You'll hear what I say. You'll see who I call, see what they say. You'll hear the conversations back and forth. It's a beautiful thing, and people love this. Is one of the best training things. They actually see me getting hung up on, getting asked questions, getting transferred back and forth. Is a best thing to see somebody go through this. There are a lot of people say, banks won't sell you notes. The last time we did this, I had 5 sources literally send me deals in the next 24 to 40 hours I was looking at, okay? We'll also throw in the Bauer financial list. This is a quarterly report we talked about that you have to pay for. It's not free to download. This last one in June that I just paid for a couple of weeks ago, I paid $360. I'll give you that list. That's a $360 value, if not more, for you. All you got to do is find one note. Woo! It's really worth it there for you. But anyway, we'll also schedule a 30-minute phone call with you afterwards. I charge $1,000 an hour for consulting. And we always like to talk with our students afterwards to give them on the right path. Hey, where are you going? What's your focus? What do you have in mind? And help tweak them. Because that's the thing. If you get started, you can get me off directly off course and be frustrated. I want you to find success, like I said, in the next 30, 60, 90 days, not 6 months, immediately. Okay? That's a $500 value. Yes, if you want to have your spouse or business partner attend, we allow them to do that. The replays, we throw that in. Okay? We also will throw in the manual, and we also have a really interactive Facebook group that we love people to be part of. About 900 members. Really great group to ask questions, network, find investors, find money. Just a great resource for those that are really doing some things. All that over $1,000. Once again, guys, the class and all the bonuses for just $49. That's it. I'm not looking. I am not. Trust me. I don't make a lot of money on $49. Okay. What I make money on and how I really plan my action here is in the next 6 to 12 months is getting deals in. Getting deals in that we can flip, we can wholesale. If you get deals, great. You send them to me. We make money together. Boom. I get deals. Hey, I found some deals. I sell them to you guys. but I'm not going to do this for free. You got to have some investment so that you show up, because free has no value. And I want you guys to take part of it. That $49, great. If you want to apply that to one of our future trainings as well, great. We'll let you credit it towards our 3-day class or online home study course as well. So why should you do this? So why should you? All right, well, that's pretty easy. First thing, most importantly, learn how to help borrowers and investors. Help yourself. Help you put some money in your pocket, but help the people out there, help the property owners, the small business owners. We need you, okay? I want you to be a note investor, everybody, okay? You can make money helping people solve problems. Make money helping the bank solve problems. Help them make money helping borrowers, tenants, whatever. It's nothing like turning lemons into lemonade, everybody. It's a sweet, sweet flavor, okay? And whether you've been looking or trying to figure out where your opportunity is in the real estate space, this is the opportunity, okay? You're not going to get another opportunity like this for a decade. And one of the biggest things, if you think back, from talking with people, think back, what were you doing back in 2008, 9, 10, 11, and 12? Well, I was in the note business. What's your biggest regret? That I didn't buy more is my biggest regret. And I don't want you guys to be looking at an opportunity here and up. Man, I wish back in 2020, 21, I was buying some of the debt. I'd been in a whole lot better place. And like I said before, I don't care what your situation is. I don't care if you don't have $5,000, if you don't have 10 grand, if you don't have 5 million bucks. You don't need to have money to do this. We show you how to do this, everybody. We all know distressed borrowers. We all know people in struggle. And like I said before, there's nothing greater than helping somebody out accomplish a dream or turn a nightmare back into a dream, or help them overcome something that was impossible. A lot of people out there right now are facing impossible odds, and they need somebody to help them out with. I can only do so much. Won't you be one of those 1,000 that we help? I would love for you guys to be part of that, okay? Once again, guys, noteweekend.com. You can get signed up there. When you get signed up for that, we'll send you the replays of the previous one so you can start watching that so you'll be more prepared with better questions for the class this Saturday. Or if you don't make it this Saturday, you can make it the one in August. We do it basically monthly. Every third Saturday is what we kind of have on the books. Like I said, it's a Cliff Notes version of investing. Quite a few of my students have come back and taken the one-day class, and they're like, oh my God, this is a great refresher. Such a great way to get started. We never expected it to be such a big hit like we did when we started in January. It's been one of our big staples now. So like I said, $49. It'll be run from 9 a.m. to 3 p.m. Central Standard Time. We usually go to 4 or 5, depending on how many people are there. The last hour, we open it with networking. So those that are on can connect, they can network and really make it a valuable thing. But like I said, go to noteweekend.com, get signed up tonight, everybody. Love to have you be a part of it. July, August, September, October, November, December, we'll do one each month. And we'd love for you guys to get started because you can learn a whole lot more by starting now versus waiting till the end of the year. So I wanted to open up for any questions that you guys might have tonight. But like I say, go to noteweekend.com, get signed up, and start putting the knowledge that you're learning and seeing in the market to your own good. All right? Any questions, comments, concerns, everybody? See if it's on Facebook here. Yeah, I miss the sandbar in San Diego. I'd be down there just talking with Steph. We'd be down there having fish tacos, watching on the water there in Mission Beach. Okay. Anyway, if there's no questions, we will let you guys get back to your evening. Thank you so much for being on here. I hope to see you all this Saturday Note Weekend, everybody. Have a great evening, and we'll see you all at the top.